Hi, this is Kelly Wright at the Money Show in San Francisco with Jeff Saut. Jeff, it's been characterized by some as a stealth bull market. Something tells me you disagree with that just a smidge.
Yeah, I think we're in a secular bull market. There aren't many of us left around that have seen a secular bull market.
Yeah.
1949 to 1966. Were there pullbacks? You bet. The Jack Kennedy steel crisis is 62, where the steel companies raised prices, and President Kennedy said, nope, got to put them back down. Markets didn't like it. It lost 30%, but it didn't stop the secular bull market. 82 to 2000, secular bull market. 87 crash, didn't stop the secular bull market.
Okay. All right, so let's help people out. All right. What's the difference between a secular bull market and, well, what other kind is there?
Well, Alan Shaw, in an era gone by, I think is the one that coined, you know, a 20% plus up market is a bull market, 20% down plus is a bear market. Those are tactical bull and bear markets.
Okay.
When the secular bull market of 49 to 66 peaked in 66, you went into a range-bound market for 16 years. If your definition of a bull market is 20% up or better or 20% down is a bear market, there were 9 tactical
I got you.
Tactical bull and bear markets in that time frame. But a secular bull market, they tend to last 14 plus years, and they tend to compound money somewhere between 15 and 16% a year.
Okay, that's pretty much classical if you go back and look at the statistics. Okay.
Exactly right.
Okay, so what kills a secular bull market?
Well, you would have to have the Federal Reserve and the ECB raising rates dramatically. That's not happening.
Okay.
You would have to have corporate animal spirits surging. That's not happening. You would have to have stocks expensive relative to fixed income. That's not happening. We transitioned in mid-2015 from an interest rate-driven secular bull market where interest rates come down and stocks expand to an earnings-driven secular bull market. And the earnings are going to continue to come in strong over the next 3 or 4 quarters, and people continue to be underinvested.
I was talking to Louis Navalier, and he said,
smart guy.
He said he'd never seen earnings like this in his entire career.
Oh, I don't know about that. In the 60s and the 60s.
Well, okay.
The late 50s, the early 60s, you had really strong, powerful earnings momentum.
That's true. Well, then we got into the nifty 50s, but that's another...
That's like the FANGs today.
You know what? That's the same thing, isn't it?
But I did the study on it. There is no more concentration in a number of stocks now than there was in the late 60s and the early 70s. The Nifty 50 peaked in January 73.
Right.
And that's where the Dow peaked at 1,051.
It just took out the 66 high.
Yep.
And then...
it was a bear market.
And then it was ugly.
It was 48% from top to bottom.
And then the Dow fluctuated between dividend yield of 5 and 6 until 1982, and that's a topic for another time.
Yep.
All right. This is Kelly Wright at the Money Show with Jeff Saut. Thanks.